Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
All right. Well, welcome back to the second half of the show. We have Tanh Truong back discussing non-residential commercial real estate. Again, our show today is sponsored by Fortress Capital. It's a private equity company that I founded to help physicians build passive income through commercial real estate. Being a physician is a high-stress job, and building passive income stream is a key to not feeling trapped in that job. All right, back to Tanh. So let's get into the details of some of the real estate things that you've done. How about we start with, what's your worst experience or your worst deal you've had in real estate?
Ooh, worst deal in real estate. So it wouldn't be a commercial deal. I haven't had any nightmare story. Actually, I did. That just happened, but I'll tell that story too. The first one was a single family property that I bought sight unseen. And this was kind of during COVID as well. And the owner sold it to me like, hey man, I can't find the key at the closing. He goes, here's $300 to get the keys redone. I'm like, oh sweet, that's fine, no worries. And after the fact, realized that the tenants were kind of dodging us. Like we couldn't get communication with them. We couldn't get rents from them, nothing. Went to their unit, nothing, right? And so we filed for eviction. And during this time, there was an eviction moratorium. So long story short, it kind of lengthened out to another few months, right? So at the point where we're actually able to get them out, ordered the sheriff, got some movers in there. And this is my first time actually looking inside the property. And I didn't even look entirely inside the property. You could smell this house from the street. I kid you not. Windows were open. Guys were in hazmat suits going in, moving stuff, right? One of the movers came up to me and he goes, dude, you will not believe what is in this house. I'm like, well, I can smell it. If that is anything, it smells like somebody died in there. They got all this garbage out, got 2 dogs, some cats, gerbils, the whole zoo, right? And I go, what is it? He goes, dude, in the kitchen, there's a 400-pound pig laying in the corner in like 6 inches of probably its own shit. And I was baffled. I was like, there's no way there's a pig in there. So I didn't have a hazmat suit, so I didn't go in. I think that's a blessing in disguise. They had to call animal control to come get this pig, right? Name was Wilbur. Shocking. And sure shit, 400 pounds. It was huge. Getting it out was a nightmare. It took a whole team of people. It broke 2 ramps, one coming out, one getting into the van. It was a whole ordeal. So I was like, man, hopefully I can still make some money off this deal. But at the end of the day, whoever we had cleaned up the whole house, got the feces out. And luckily, with all those costs and the acquisition costs, we sold it for break even. So that was probably my worst residential deal and a story that I'll never forget. So on the commercial side, and this really just
what's your lesson you would say to avoid that?
I think it was really just my fault in general, the whole team's fault in terms of my partners and I, because they were kind of pushing me to get this thing under contract and just purchase it because the numbers worked, right? And I kind of overridden my gut feeling. I'm like, we got to go see this, right? Like, what if the whole foundation's messed up, whatever. And essentially we were just too trusting, right? So the lesson is, no matter what anybody tells you, trust, but verify. And obviously don't buy a property sight unseen.
A lot of people have. Actually, I did once. I bought a house when we moved, and we'd gone and looked for houses and couldn't find a house, and we were just looking for a rental. And then the agent called back and said, hey, I found this house. It's a great deal. And we bought it sight unseen and got there, and there wasn't a pig in it, but it smelled almost as bad. Yeah, the sight unseen's a bad thing. bad things.
Yeah.
And somebody you trust to look at it if you can't.
Yeah, it's tough. But yeah, so on the commercial side, I wouldn't say I had a bad deal. No pig, definitely no pig yet. But over the weekend, what's today, Wednesday? Yeah. Over the weekend, Sunday, there was someone who, I don't think they were overdosed, but they were on methamphetamines and ran into a pillar, a supporting post on the strip center, and crashed into one of our tenants' units. And so that's a nightmare, got to deal with on the insurance side. So just random stuff like that. From a investment perspective, though, I'd say the numbers are still as projected and they're doing just fine.
Yes. So that's one that, is the difference for when people are looking to invest as a doc, the difference between investing actively and passively. If you like building the deal and you don't mind getting the pig out of the house or the meth addict car out of the strip center, that's just some of the stuff you deal with. It's not every day, but it is some of the stuff you deal with. But for people who I don't want to deal with that, that's where there are opportunities to invest with other people, and you can just do it passively. And that's a great thing as a doc, and you still get a lot of the tax benefits and such from it.
Absolutely. Personally,
go ahead,
Mike, I think passive is the way to go. Looking from an operator's standpoint, I'm looking through it, the lens firsthand, right? And, there's a lot of moving parts. There's a lot of pieces that you have to manage, right? From an accounting perspective to dealing with tenants, to lease ups, to the construction aspect, to dealing with the city, right? There's a ton of stuff when it comes to commercial, and you have to know what you're doing in order to operate it well. So if you're someone who's great at multitasking or great at project management, the active side might be for you. Personally, I'm more of a fan on the passive side because you're pretty much looking for or interviewing some of the great operators out there through word of mouth, right? Figuring out whether or not they have the integrity that they say they do, or the transparency that they say they do, and whether or not they can fulfill the business plan that's in relation to a investment. So once you find that, so the first piece there is the interview spot, an interview piece, right? From there, it's just pretty much following along the deal and seeing if they're doing what they say they've done. And obviously, as an investor, you're getting a piece of the pie, right? Whether it is 8%, 10%, 5%, whatever, right? And you're kind of a bystander, but you still get a piece of this deal, right? You're still making the returns that the deal should be projected to make. And on top of that, yeah, I think the tax benefits are phenomenal. And you literally didn't really have to lift a finger. So yeah. Huge proponent. I'd rather be, I don't know, in Costa Rica or something, while passively investing in a deal, right?
Yeah, you made a good point about the talking to the operators, and that's a big difference. It's a shift from, buying stock. I've never, and maybe I should have, called a company we're buying stock in. Nobody ever says call and talk to the guy running it. But when you're investing in real estate, it is part of what you do. And some of the bigger operators, you're going to talk to their investor relations team. But a lot of time, you're going to talk to the guy running the show. And I think it's a great thing to do because you can ask them questions and get to know them some. And if you don't if something hits you wrong, walk away. There's plenty of people to invest with, to find people who see the world the same as you do.
Absolutely.
And I think that's a big one. If they don't ask you, what are your goals? What are your goals as an investor? Why are you here? That's a good place. That's where they should be starting. Because some deals aren't made for, if you're calling and, you're like, I'm looking for regular income. I want a check every month to pay my bills. And, it's a land entitlement deal that may turn a great return, but your money goes away for 9 to 18 months and then it comes back bigger. It shouldn't be putting you in that deal.
Right. There has to be some alignment of interest, right? Obviously you want to make sure your operator has some skin in the game as well. And you don't want to get on a bus or a boat that's going in the wrong direction, right? You guys want to have the same destination in order to sail there, right? So whoever the operator is, if they don't have the qualities that you're looking for, the character that you're looking for, that's an automatic red flag, right? And to piggyback off your point, they should be asking what your goals are. Because if they're just taking money from everybody or anybody that is willing to write them a check, that's a huge risk. You want to make sure that whoever you're investing with is, whatever your project is, it aligns with their goals. Because like you said, it could be a land deal where you're not getting paid for a while. And if this investor wants this, and that, on a monthly basis, quarterly basis, et cetera, the right operator would say no. But the red flag one would be like, oh yeah, man, write me this check.
And it's also a cool thing about real estate that's you can find people who see the world similar to you and you develop friendships and relationships to it. It can be more than just, buying some shares of Coca-Cola online. And so that's another cool thing about it. So I want to go back to your strip center. So every time I talk to a doctor about a strip center deal, their eyes, they look like they just saw a tiger jump out of the bush. And they look terrified. And, of course, you'll hear, well, wait, what about Amazon? And retail's dead. And it's just a scary thing. I think it's easier to buy a house and rent it because at some point we've all rented a house. Like, okay, I'm going to just be on the other side where retail gets scarier. So what would you say to, why do you like strip centers or strip malls, retail centers? What's the appeal there? And what are the things you're looking for? And what do these look like?
Oh man, there's a ton of factors why I like a retail, but I guess I'll try to make some comparisons with multifamily. I think multifamily is easier to understand for a lot of people. There's a ton of education out there, right? It's simpler, if you will. So let's say you had a tenant, a residential tenant, who is literally the perfect tenant, and they've only been with you for a year, right? They are clean. They even painted their unit. If the appliance goes out, they purchase the appliance, right? Let's say the fridge goes out, they ordered a new fridge, threw out the old one, right? So literally the perfect golden star tenant, right? Pay the utilities, never calls you, clogged toilet, they take care of it, right? Now let's say their lease is ending and you want to renew with them, right? And let's say you signed a 5-year lease with this particular tenant because they've done such a great job. I think a lot of the audience would say, yeah, I'd sign them in a heartbeat for 5 years, right?
Yeah.
So that is how a retail tenant is, or a commercial tenant in general, I should say. But I can't say all of them are great, right? So you have different classifications of tenants. You have your mom and pops, or you have regional tenants, or you have national credit tenants. National credit tenants are probably your safest bet because they're the least likely to break a lease. So that national credit tenant, or even sometimes a regional tenant, and in some occasions, even your mom and pop tenants, are that particular perfect tenant. They're operating a business. They hold themselves in high regard. They like to keep their place of business clean. They do pretty much everything to their unit, right? And obviously, there are some caveats there with negotiations and whatnot on who's responsible for what. The other thing I like about retail in general is that there are, like you said, Mike, a lot of people are like, oh, what about Amazon? What about Chewy? What about these big internet companies, that are delivering stuff straight to my door, right? And I agree. That is a killer for some retail businesses. But you can't buy company online. Company being, friends. You can't buy that aspect online and have a beer with them, right? You can't enjoy a meal with them. So you can't buy that. I mean, you can buy uncooked food, or you can buy cooked food delivered to you, right? Just a different atmosphere. You can't buy a haircut online. You can't get your nails done online. So a lot of service-based businesses will stay in business, right? And with businesses, there are cycles, right? Technology is phenomenal, but it does put a damper on things sometimes. So in a sense, businesses have to learn how to adapt So the weak ones will die out, but the ones that are cognizant of the technology wave will begin to adapt with technology and find ways to thrive and survive in those conditions. So aside from the fact that I don't have to deal with clogged toilets and long-term leases, right? I deal with business owners. It's another partnership that you are involved in. You are responsible for their success. You're helping them kind of figure out ways to elevate their business, right? Just working through some of those puzzles is really enjoying. And it's kind of cool at the end of the day to learn about their business too, right? Because it gives you a good feel in the business world. Like if you love business like I do, it's what I enjoy the most out of the retail space. So aside from that, I think, the numbers are just larger. So some of those things are why I like retail.
So what a doc told me last time we were looking at a retail center together, and they were like, well, this is really risky. Is it this risky? And so there's a perception that, well, everybody needs a place to live. That's what the multifamily folks say. But there are ways to de-risk that retail center can actually be less risky than an apartment building, like a value add. So just walk us through a little bit, like, okay, so finding a strip center that's 70% full, how can that be a less risky investment than buying an apartment building?
How is it less risky? Well, when we're looking for acquisition, we always try to buy it at the right numbers. It has to have a margin of safety there, right? So at 70% occupied, I would like to see it at a point where it can sustain the mortgage, right? Let's say another one or two tenants leave. Let's say it drops down to 50% occupancy. That 50% occupancy, I want to be at least break even, right? To the point where you're not losing money. So at 70%, you should be making something, right? So that the other 30%, so that's your margin of safety there, right? Buying it at the right price to the point where even if you lose some tenants, you can still make out okay, right? And now a lot of it comes from your analysis and evaluation of the property too. So you're looking at a property that's 70% occupied. So now if you have consistently all mom and pop tenants, that is a higher risk than if some of your tenants in that strip center were a national credit tenant or an anchor, if you will, right? If they're established businesses or nationally recognized, they have less of a chance of defaulting. So the risk there is offset. Whereas with a mom and pop tenant, they could go bankrupt tomorrow. And now you're sitting at hopefully 50% occupied with them leaving, right? So you assess your risk that way. I mean, I do agree, multifamily, everybody's always going to need a place to live. 100% agree. But it's not 100% risk-free. There are some risks with it, right? Higher turnover sometimes, government regulations, things like that. So with retail, you can also assess your risk with having a plan in place beforehand. So if you buy it at 70% occupied, you want to get the ball rolling pretty quickly, right? You want to make sure you get those places filled because worst case scenario, if another 20% drops, you're at 50% occupancy, or if you're already teetering with the timeline. So we try to fill things as quickly as we can. So that comes from, you can utilize a lot of free ways to find tenants, social media, Craigslist, bandit signs, cold calling, canvassing, right? So yeah, it comes from analyzing the property correctly, looking at it from a vantage point where you have some room to go before you actually get to the break-even point so that at the end of the day, you're not losing money. Hopefully that answers your question.
It does, but let's see. So if you're going to go buy a duplex, that duplex is going to sell for a similar price, whether there's nobody living in it. It's the same niceness, doesn't have a pig in it, but it's got, if it's a duplex and it's sitting there and one side's rented, none of it's rented or both sides rented, it's going to sell for the same price, essentially.
Correct.
But if you have a strip center that has 10 units and 7 of them are full, the price it sells for is based upon the money it's bringing in. So if that's selling and it's, 100% full, if it's 70% full, when you compare, so it's making 70% less money, it's going to sell at 70% compared to the full strip center.
Correct.
And so if you buy that, and if you're a good leaser, like you were saying, and you get out ahead, so even before you've closed, you find tenants and you got people ready to go. And once you're out in the world and working and people are like, hey, are you buying another one? I need a store. You could actually be picking this up at a lower price and see if you can rent it before you ever close. And if you find out that, wow, this isn't rentable, this is a bad idea, you don't go through with the sale. To me, that's like this magic. Like when I found that out, I was like, wait a minute. You can do what? And it's almost, and when you take that and now it's 100% full, like you go sign up, somebody was just lazy. They weren't renting it. And you go and you find new tenants for those 3 empty ones. And so you sign and you close, and the same day you sign leases with them. And now it's full. It's now worth a fully rented. You could have increased the value $1 million.
Yep.
Turn around and sell it the next day. And maybe you don't want to, but to me, that seemed much less risky. And I'm sure there's some of that in multifamily if you're buying an apartment complex that's half full versus full, but it's not to the same extent. And to me, that's just the coolest thing with these value add plays, where you can do things that take risk away and make money and it's all paperwork. Then you're just adding value on paper. I don't know. That just was the coolest thing, because I went down the same road and I guess I was looking for when I talk to docs, I'm trying to explain this and I don't feel like I explain it well because they're like, oh no, everybody's seen, the 1970s deserted strip mall. And that's what they see. They're like, wow, that's really risky. I think it's totally different. So now the warehouse business, I have no experience in warehouse, but I live in Green Bay, Wisconsin. There's a lot of warehouses. It's an industrial town. And I see a couple I drive to work every day. And there's one warehouse I drive by every day and it's for sale. And I have no idea how to evaluate a warehouse. I mean, how to rent a warehouse. Tell me a little bit about warehouses and how that works.
I personally love warehouses. So when you're looking at Amazon's or the internet businesses, right, they all need space. So where are they going to store them? In these giant warehouses, right? Which is why you see a lot of more demand for warehouses and their prices tick up a little bit on the higher end, right? The reason why I love them is because they're pretty much the lowest maintenance out of anything, right? It's literally a box, probably a metal prefab box on top of concrete, right? Less HVAC issues you have to deal with. And now, if we get into like flex space where there's offices, different story. But the audience should know that there's obviously different classifications of warehouses. You have your light, medium, and heavy manufacturing. Obviously, on the heavy manufacturing side, there's heavy machinery. So your maintenance is a little bit more dependent upon how your leases are. So a lot of times when you're looking at these warehouses, it's important to look at the ceiling heights, because now you have to be cognizant of what type of businesses are going to be operating in these warehouses, right? Some of them have these giant machines that are, 14 feet tall, 16 feet tall, something like that. So being cognizant of that, the electrical capacity in the unit is two of my probably largest or most important questions that I ask right off the bat to make sure that I know who I can market to what type of businesses, if you will, that can occupy that space. But once again, the management side, you can have triple net leases in warehouses. You can have absolute net leases, or it could be double net, single net, or modified gross or gross. Any of those leases are operable within any of the commercial spaces, obviously aside from multifamily. But if you're able to land an absolute net lease in a warehouse, that's amazing. That's 100% passive income, right? So that's just like if you lease out to a McDonald's. So when I say absolute net lease, that means essentially the tenants pay for X dollars per month or per year, right? And they take care of literally everything.
So it's almost like they bought it.
It's almost like
they're taken care of.
Almost like they bought it, but your name's on the deed.
And they still pay you every month.
If the roof goes out, they take care of it. They take care of all their trash, etc. Now, when it comes to how do you value it, you have to know the market, right? And there's paid versions of databases that you can look out there. Pretty pricey in my opinion, but the cheapest way to do it, go on LoopNet, go on Crexy, type in your area, look for warehouse, and see what's listed, right? And this is not the 100% accurate way of doing it, but it'll give you a barometer of what these brokers think the market is doing, right? So if they list it at a 7% or an 8% cap rate, you could be like, okay, maybe it's worth somewhere between 7.5 to 8.5, right? So there's a little bit of wiggle room. It gives you an idea of what it's going for. Now, obviously, from that perspective, if it's tenanted, now you have numbers to work with. So you can figure out what their income is from the tenant's rent, what expenses there are based on the type of lease, single, double, triple net, or absolute net. And from that aspect, now you can reverse engineer it, do the math to figure out what the purchase price should be and whether or not you can buy it at that price to make your desired returns. Now, if it's vacant, that's a whole different story. So that comes with a little bit more digging. So if you don't have some of these databases and you're not able to see what property has sold for in the past, you have to do a little bit more manual labor. So calling some brokers, doing some shadow shopping, right? Saying like, hey man, can I get 15 minutes of your time? I just want to learn a little bit more about this area and this type of property. What do you think it would sell for? And a lot of times I like to compensate them for their time, get their address, send them a gift card or something like that. Or if you're pretty savvy in the construction space and you are able to find out what the build costs of something like this is for your retail consumer, if you will, then you kind of have a barometer now of where that purchase price is and where it falls if it's above or below your typical build price. And that'll give you kind of a good idea of where you should be in terms of your offer price or whatever.
Awesome. It's just when you start digging into these things you don't know about and learn a little bit, and then they turn out that it's not a black box, it's not magic, something to spend a little time on and you can understand it. And it just opens up all kinds of new doors. Well, thank you so much, Tanh. This has been awesome. Learned a lot about some different asset classes. Any last advice, best advice you could give to a doctor who's looking at trying to do something beyond being a doctor or investing in commercial real estate?
Oh, man. I think every doctor should passively invest in something. You're making a ton of money, right? Superiorly modest income. I think you should put that money to work. Let it do something for you so it buys you back a little bit of time. And obviously you want to, once again, harping on the operators and whatnot, learn who to trust and understand the asset class that you're investing, right? And if you don't understand it, reach out to Mike, reach out to myself, reach out to somebody who's been in the space that can, give you an hour of their time or 2 hours of their time, whatever, to actually educate you on the beast before you throw any money, right? I guess my best advice is probably my favorite quote goes, Tony Robbins quote. It is, the secret to wealth is simple. Find a way to do more for others than anyone else does. Become more valuable, do more, give more, serve more.
Perfect. Thank you, Tanh.
Absolutely, Mike. It was a pleasure.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.